Actually, before we dive into the next session, I just want to cover one real quick more thing on this slide. On the chart on the right side, I have this chart here on purpose because this chart shows retail trader thinking. All right, retail traders, when price has already moved substantially up a lot, which confirms the trend, even though the trend is already confirmed a long time ago by institutions, they know exactly where they're going to be buying. They already made the big move up. Basically, a lot of retail traders are in a FOMO and they're going to try buying up here at the greed/buy section where the arrow is pointing. When in reality, they don't realize there is resistance there. This is why technicals also play a role in trading. So you want to combine both emotional psychology along with your technical trading. This is not easy to do in the beginning, but it gets a lot easier in the long run. This is the chart of basically what retail traders think. They are greedy and they buy when price is already at a high. You just don't see this in hindsight. You just don't realize it's already a high. But they're trying to buy breakouts of these highs while they're trying to sell and they're fearful when price is getting to a very low price or it's dropped a lot. They're looking to sell price or they're very fearful, so they sell out of their position way too early until they realize, oh, this was actually a reversal here. They basically, the retail traders are literally almost selling close to areas where price is already reversing against them. And this is why 9% fail, because 9% also they fail to recognize their psychology and how they're viewing the charts. When price is at this low, if we confirm there is a demand zone or supply zone here, and we can confirm there are buyers here or institutions are going to be buying this area, we should not be selling out of our positions, for example, or we should not be going into a short or put option position. We should be looking to buy here. When retail traders are selling, we should be looking to buy. When retail traders are buying, we should be looking to sell. Simple as that. We should be thinking the complete opposite of what retail traders are thinking, because that's how institutions think. This is another logical thing I found in the market is if there has to be a buyer for every seller in the market, institutions with these massive trading capital amounts, probably hundreds of millions per trading position to move the market this much, they definitely have 100 million in each position, each position, not just one day trade, not multiple institutions. One institution can have millions of dollars in one position. What does that mean? That means they need 1 million people or $1 million on the other side so they can buy or sell their position to, right? So when retail traders, their institutions are waiting for enough retail traders to buy at these areas where they get greedy so institutions can get into their sell positions. This causes an exchange between the two where buyers get stopped out because their stop loss, for example, is going to be right here, right below, and they're going to get stopped out, which causes tons of liquidity that allows these institutions to take advantage of this liquidity and convert their positions into sell positions. So all these buyers that got stopped out, well, guess what? They're basically giving back their position. They're selling their position to the institutions that are selling. So the same thing on the bottom here. When retailers are selling their position and they get stopped out, tons of liquidity forms, institutions are buying the sold shares. That's literally how it works. That's why 9% fail, and we need to be part of the 10% that follow the institutions. Now, another important thing, we can talk about strategies we can use to practice controlling our emotions while trading. These are strategies I came up with that really helped me during my trading process to profitability. So these are things that I would highly recommend you guys try out and see what works best for you. Number one is focus on being present in the moment of the trade. You want to be actively controlling and thinking about what are you thinking in your mind right now aside from the technical aspect of the trade. What emotions are you feeling? Write it down on the chart. Even I think that's my best idea is live journaling on the chart as the trade is progressing. This way you're facing your emotions directly rather than trying to hide them. Journal all your trades at the end of the day and take note of any emotional or rational decisions you made and reflect on them. Another key thing when it comes to practicing your emotions. You can be journaling after you take the trade as well. If you live journal and take your journal your trades after, you are able to see 2 aspects or even 3 aspects of the trade. Like we mentioned, your emotions before the trade, during the trade, and after trade. 3 aspects of emotions you should definitely be monitoring. Number 3, if you're naturally greedy, understand this and take profits earlier. Vice versa, if you're fearful, we talked about this previously. You want to understand who you are as a person, you want to balance this out. And to balance this out, you want to once you accept you're greedy, you want to balance this out by taking action. So if you're naturally greedy, take profits earlier. All right. If you're naturally fearful, hold positions longer. Don't sell until it hits your stop loss. All right. There's a lot of things. These are very common sense things that a lot of traders just can't implement because they just can't face their emotions directly and cannot execute. Emotions are crucial in trading. Number 4, try taking some time away from the charts if you've been trading all day. You can't be sitting on the chart for 8 hours a day, man. Trust me, I used to do this for more than 8 hours a day. I would be back testing for nonstop. This usually applies not only to back testing, but more so to active trading because that's when you're putting on risk. And you want to be in a good mental state of mind when you're putting on risk like this. And if you're spending the whole day on the chart putting on risk, you're going to force yourself to take so many irrational decisions and even like try to revenge trade if you're losing money already. The more you stay at the chart, or not the more you stay at the chart, but if you're staying at the chart the whole day, you're going to be forcing your mind to find ways to take a trade. There's no trading opportunities or setups that follow your rules. Don't take the trade. It's that simple. Protecting capital is number 1 in trading. Most new traders don't understand this until they lose all their money. That's the truth. Number 5, establish a solid technical trading plan. This involves a take profit or multiple take profit areas. Take profit can be dynamic, same with stop losses, and just know the confluences for your trading plan. When should I enter a trade? When should I not? And this will tremendously decrease the emotional decisions you have to make. Literally, you won't have to make these emotional decisions if you try to focus on the technicals and just focus on entering off the technicals. You will become a bot in a good way. Now, number 6 is if you're feeling too stressful, divert your attention to something else while you're in a trade. Now, I wouldn't really recommend this a lot. It really depends on how you're trading. If you're scalping within minutes, I wouldn't recommend diverting your attention, obviously. But if you're holding a position that's like 30 minutes or longer and you're feeling too stressful, definitely recommend diverting your attention to something else in the meantime and let your trade run. But you still want to be actively monitoring your trade. So I would highly recommend setting alerts if you have to. Now, this is something you definitely have to overcome in the beginning. I do understand a lot of traders in the beginning will feel stressful, but once you get used to trading, you need to be able to face this stress head on at some point because the best way to make the profits and reduce losses is to try to actively look at the trade and take the new information the market gives you, right? You're trading off of previous past technical data, but as the market presents more information to you, you want to, take this insight, take this information, consolidate it, and understand it. This will tell you whether you should maybe get out of a trade a bit earlier if there's something really major going on. Technical aspect, again, technical and not emotional. If you're just getting out of motion, if you're just getting out of a trade early because kind of scared, I'm not gonna lie, or just subconsciously you're just scared, just stop trading. Don't stop doing that. All right, just stick with your plan, and there's that. That's it. But this again is only something for beginner traders. At some point, you're gonna have to face reality, face the trades head on, and reduce that stress. The stress could also be caused by over leveraging though, or risking too much if you're not comfortable losing it in the first place. So a lot of traders, they have this stress because they are risking too much. If you're feeling your heartbeat like pumping, you definitely over leverage. For a fact, you should know what your risk is before your reward. You should know actually no, that's false. You should know your risk and reward before you get into a trade, but you should know that you're comfortable with this risk that you're taking on before you look at the potential reward. Because if you lose a trade, you're guaranteed to lose that much. But if it's a winning trade, you're not guaranteed necessarily your full take profit level. It might be not as much reward as you thought. So that's something to keep in mind. Last but not least, you should be viewing money as nothing but a tool to learn more in trading. This mainly applies to beginner traders in the first year of trading. Would highly recommend, again, everyone's trading journey is different. Some people learn faster, some people learn slower. A lot of this also depends on how much effort you're willing to put into trading, right? How much really effort are you willing to put into trading, putting time and dedication into trading alone, and just focus and grind. When I say grind, I mean grind your butt off. All right, focus on the process, not the money. That is a fact. That's something that I live by for trading. Focus on the process, not the money. in the beginning, definitely should not be focusing on the money. So you should definitely have other sources of income in the beginning for sure, because this is going to help you focus on the process, not the money. They want a rich person. If a rich person got into day trading, they're not going to be caring too much about the money. They're going to be caring more on the process. And this rich person, in fact, because of this mindset they have, they actually will become profitable faster. So focus on the process, not the money. Money comes as a byproduct of trading. All right, this is something even sometimes I try to recognize and tell myself should be focusing on the process and not the money. The money is a byproduct, and the money will come once you master the skill of trading. The money will literally come naturally to you. It's not something you should be forcing. It will come naturally to you. As you get better at trading, you will see results, and results equals money. All right, that's how you should see it. So I'll highly recommend the first year at least minimum. Don't view it as a get rich quick scheme. It's not how it works. It's now how a lot of these traders make it seem to be, where they flip $1,000 to $1,000,000 in, I don't know, a first month or so. And I'm not saying that it never happened. That could have happened, but that definitely happened from luck. If that did truly happen, or they're lying. So it's one of the two, because we know for a fact that was true and that was very realistic. These hedge funds, they'll be flipping 100 mil to way more money that we could imagine. So obviously, unrealistic. Make sure you're setting realistic expectations for trading.